tragedy in America that small investors have been convinced by the media, the print media, radio, television media. They don't have a chance. These media giants have convinced many small investors they can't compete with big institutions. With all their computers and degrees and money, it just isn't true. When this happens, people act accordingly. When they believe it, they buy stocks for a week, and they buy options, and they buy the Chile fund this week. Next week it's the Argentina fund, and they get results proportionate to that investing style. That's bothersome. The public can do extremely well in the stock market on their own. The fact that institutions dominate the market today is a positive for small investors. These institutions push stocks on usual lows. They push them on usual highs. For someone that can sit back and have their own opinion and know something about the industry, this is a positive. It's not a negative. So that's what I want to talk about. The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people who own stocks would not be able to tell you why they own them. If you press them, they'll say, "The reason I own this is because the sucker's going up. That's the only reason they own it." I'm serious. If you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. That's true of about 80% of people who own stocks. This is the stock people like to own. This is the company people adore owning. These are relatively simple companies, and they make a narrow, easy-to-understand product. They make a 1 megabit, SRAM, CMOS, bipolar risk, floating point data I/O array processor with an optimized compiler, a 16-bit dual-port memory, a double-diffused metal oxide semiconductor, monolithic logic chip with a plasma matrix vacuum fluorescent display, with a 16-bit dual memory with a Unix operating system, 4 Whetstone megaflop polysilicon emitter, a high bandwidth, that's important, 6 GHz double metallization communication protocol, an asynchronous backward compatibility, peripheral bus architecture, 4-way interleaf memory, a token ring interchanging backplane, and it does it in 15 nanoseconds of capability. If you own a piece of crap like that, you will never make money. Somebody will come along with more Whetstones or less Whetstones, a bigger megaflop or a smaller megaflop. You won't have the foggiest idea what's happening, and people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there were recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I can understand it. And you laugh. I made 10 or 15 times my money in Dunkin' Donuts. Those are the stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. It bothers me that people are careful with their money. The public, when they buy a refrigerator, they go to Consumer Reports. They buy a microwave oven, they do that. They ask people what's the best radar range or what car to buy. They do research on apartments. When they go on a trip to Wyoming, they get a mobile travel guide. When they go to Europe, they get the Michelin travel guide. People hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. When they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. That's what we're being driven to. And it's self-fulfilling. The public invests terribly, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks to go up. This is magic. It's a magic number, easy to remember. Coca-Cola is earning 30 times per share what they earned 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. They try to predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. If anybody can predict interest rates right 3 times in a row, they'd be a billionaire. Certainly there's not that many billionaires on the planet. I took logic, syllogism when I studied at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires, and no one can predict the economy. I know a lot of people in this room were around in 1981 and 1982 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I read, I study all this stuff. I don't remember anybody telling me we'll have the worst recession since the Depression. It would be useful to know what the stock market will do. It would be terrific to know the Dow Jones average a year from now, to know we'll have a full-scale recession, or to know interest rates will be 12%. That's useful stuff. You never know it though. You just don't get to learn it. You should study history. History teaches you the market goes down. It goes down a lot. The math is simple. There have been 93 years this century. The market has had 50 declines of 10% or more. With 50 declines in 93 years, the market falls at least 10% about once every 2 years. We call that a correction, a euphemism for losing a lot of money rapidly. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines of at least 25% in 93 years, so every 6 years the market has a 25% decline. That's all you need to know. You need to know the market will go down sometimes. If you're not ready for that, you shouldn't own stocks. It's good when the market goes down. If you like a stock at $14 and it goes to $6, that's great. You understand the company. You look at the balance sheet. They're doing fine. You hope for $20, $14 to $22 is terrific. $6 to $22 is exceptional. So you take advantage of these declines. Declines happen, and no one knows when they'll happen. People tell you they predicted it, but they predicted it 53 times. You can take advantage of the volatility of the market if you understand what you own. That's a key element. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. It already had a great record with 15 years performance and a great balance sheet. You're a conservative investor. You're not sure if Walmart can make it. You want to check. You see them operate in small towns. You're afraid. They make it in 7 or 8 states. You want to wait until they go to more states. You keep waiting. You could have bought Walmart 10 years after it went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money. But you could have waited 10 years after it went public and made over 30 times your money. You could have waited 3 years after Microsoft went public and made 10 times your money. I know nothing about software. If you knew something about software, you would have said, these guys have it. I don't care who's going to win Compaq, IBM. I don't know who's going to win Japanese computers. I know Microsoft, MS-DOS is the right thing. Stocks are not a lottery ticket. There's a company behind every stock and you can watch it. You have plenty of time. People are in an amazing rush to purchase a security. They're out of breath when they call up. You don't need to do this. You need an edge to make money too. People have incredible edges, and they throw them away. I'll give you a quick example of SmithKline. This is a stock that had the successful drug, Tagamet. You didn't have to buy SmithKline when Tagamet was doing clinical trials. You didn't have to buy SmithKline when Tagamet was talked about in the New England Journal of Medicine, or in the British version, Lancet. You could have bought SmithKline when Tagamet first came out or a year after it came out. Let's say somebody in your family, or you are a nurse, a druggist, or a physician writing all these prescriptions. Tagamet was doing an amazing job of curing ulcers. It was a wonderful pill for the company, because if you had stopped taking it, the ulcer came back. It wasn't a crummy product. You took it for $1, and then it went away. You could have bought it 2 years after the product was on the market, and made 5 or 6 times your money. All the druggists, all the nurses, all the people, millions of people saw this product, but instead they're out buying oil companies or drilling rigs. It happens. Then 3 or 4 years later, Glaxo, an even bigger company, a huge company, a British company, bought Zantac, which was at that time an improved product. You could have seen that take market share and do well. You could have bought Glaxo and tripled your money. You only need a few stocks in your lifetime, they're in your industry.